Hello everybody, it's Tom Sheridan and Chris Darbyshire here to talk about the Q2 Asset Allocation Committee and what the results of that discussion were, which were just held a couple of days ago. Now, as we've said a couple of times, and Justin's fond of reminding me, we live in a Jeffrey Archer type world right now. You just wouldn't believe what's happened over the last 18 months or so, politically, but yet economically, it all seems to have been all right. The US has been pretty strong, the UK very surprisingly strong, Europe's been okay, China's been okay, Japan's been okay. So economically, we've been looking at a very benign environment, and the markets have picked up on that, and the markets have actually focused very much on the good political events of the last couple of months. Just in the last few days, we're seeing the possible resurgence of inflation, particularly in the US and in the UK, for slightly different reasons. And we see the Fed raising rates already. So on the back of that, we have in the background the specter of politics derailing, disappointing, all of that economic good news. We really can't get away from talking about politics, so why don't we start there? Give me an idea, what's going to happen over the next 3 months on the political landscape?
So the next few months are going to be quite important in terms of politics. And politics is important for the long-term direction of markets and the long-term direction of the economy and economic growth. We have Trump, who is battling, with the conservative part of the Republican Party, and also, not always in alignment with the moderate part of the Republican Party, trying to get legislation accomplished in the US in line with his promises to voters before the election.
So the Republican Party is actually not one party anymore, is it?
No, it's been split really ever since the Tea Party came into being in 2009. So you've got these two factions within the party that you're always trying to balance, and whether Trump's ability to balance them is going to determine whether he is a successful president or someone who is just perceived to be stuck in the swamp, unable to get stuff done. So that's a critical few weeks coming up.
So the relevance to us for that is whether or not he can get his legislative agenda through, because that's indeed what some of the market reaction has been about. They've been looking for infrastructure spending, they've been looking for tax cuts, and here we are saying, well, actually, can he get it done now?
Yes, and in American politics, to get tax reform done, he has to get healthcare put to bed first. So until he can get everything lined up nicely, you could see things being delayed, then you're out past the midterm elections into 2019, and then you're into another presidential election before you know it.
So possibility number one of disappointing our good friend Mr. Trump sitting in the White House. Let's talk about Europe a little bit.
Yeah, so Europe, we've got the French election coming up. We had a good result in the Dutch election from the point of view of the status quo being preserved, so market volatility being kept under control. French presidential election could throw up a surprise. But then, of course, we have the French parliamentary elections following about a month after that. And that's also very important in terms of the balance of power in France and whether the policies could push towards the sort of more extremist policies that we see Le Pen advocating.
So, Chris, if I read your body language right, you're thinking that Europe might turn out a little bit better than what the market's afraid of.
Yes, I think markets are pricing in some fear and some risk in Europe, whereas they're not really pricing in any fear or risk in America. They're kind of giving Trump the benefit of the doubt completely. Whereas in Europe, I think they're a bit more cautious. So there's more upside in Europe if Le Pen doesn't get elected.
And here at home, the hard slog of what Brexit really means is starting to take shape. So we're seeing Article 50 getting invoked now. Are we going to have anything but a hard Brexit?
Yeah, looks like the UK is pushing towards a hard Brexit because it will not accept freedom of movement of peoples and will not accept the jurisdiction of the European Court of Justice. That means a hard Brexit. And on the European side, they seem to be content with that as well. So that seems to be the path we're taking.
And you're not completely convinced, I don't think, if I'm reading your body language correctly, that the risk of hard Brexit is really fully in the market.
No, I think there's, certainly among the press, there's a very rose-tinted view of what that looks like. And we're worried that the reality is going to be really quite different. The devil is in the details in all of these things. And the details, when you get down to it, are very complex. And I don't think markets are fully pricing that in yet.
So the sheer scale of the negotiation that has to take place within 2 years combined with the actual talent available to conduct the negotiations, poses a real risk.
Yes, it does, and I think the emotional sort of atmosphere surrounding the negotiations will be very different from a normal free trade negotiation where you're trying to marry. Here you're trying to divorce, and it's going to be a volatile period for the pound.
Okay, and surprisingly, here we are, the developed world, the source of all the political uncertainty. We look to emerging markets, look to China in particular, remarkably quiet.
Very stable. The stimulus, the incredible growth in the housing market over the last year has contributed a lot, I think, to global growth, and it's really helped stabilise the stock markets in China and beyond. And that seems to be likely to continue on for at least another few months. We have the National Party Congress coming up in China at the end of the year, which is a sort of a big event in China, akin to a general election over here, if you like. So before that, we don't see where the volatility comes from.
Okay, so good economic backdrop pretty much around the globe at the moment. Political risks, as we just described. So what are we doing about it? Let's start with equities.
So in equities, we decided that we've chased the Trump trade, as it were, long enough. We're beginning to cut back on American equities. That money is going into emerging markets where we think there's more genuinely dynamic growth going on rather than just hope and expectation of a tax reform bill. So lots of good trade flows, for example, in Asia at the moment.
Plus the possibility of the 35% tariffs on imports into the States. It just hasn't happened, and it doesn't look like it's really on the radar screen right now.
Definitely seems to have gone off the board. That was something we were very concerned about last quarter. Trump had promised to declare China a currency manipulator on day one of the presidency. We didn't feel we could own that market at that time, but we're a bit more confident going back in now.
Okay, so a bit of money from the US to emerging markets. Europe?
Europe, we're cutting back a bit in the lower risk portfolios ahead of the presidential election. It's been a good place to be for the last few months, but we're keeping our foot on the gas in the higher risk portfolios because we genuinely do think it's going to turn out to be a positive surprise.
Okay, interesting that we were differentiating by risk profile how we approach the equity allocation there. And probably last but maybe not least, the home market, the UK. What's our thoughts on the UK?
Continue to avoid UK economic risk simply because we really don't know what the next 2 years will hold or where we will end up. So we feel there are good opportunities to get the returns that we've targeted through other means, so let's take those other routes and not take unnecessary risk. Having said that, I think we're becoming a bit more concerned about sterling in the short term. We've been generally concerned about a sterling rally up to now. We put in place a call option on sterling against the dollar to try and take care of that possibility. And while that sits there, it gives us a bit more confidence that we can begin to worry about sterling weakening possibly over the next couple of months.
So more or less, we've got about 30% of the portfolios exposed to currencies other than sterling right now, which is not a very aggressive position.
No, that will probably move to about 36%, which is still more sterling than we would normally have and more sterling than our strategic asset allocation has, but it shows the direction of travel we're moving in.
So really on the back of fear over what happens when the reality of negotiating Brexit hits the press.
Yes, we think the press in the UK have painted a pretty rosy picture of what it could be. The devil is always in the details.
And of course that's governed by the world of politics, so who knows what happens there. Now, other than equities, fixed income, we haven't really liked fixed income or traditional fixed income, government fixed income, if you will, for a couple of years now. What's our current thought on what are we doing with fixed income?
We are putting a little bit more fixed income, a little bit more US government bonds back into the portfolios at the moment, simply because they've had a sell-off and we don't think the world looks quite as rosy as it did a few months ago. It's not a huge position, it's moving from 2.5% to 5% in the balanced portfolios. We're still generally quite underweight fixed income. The long-term trajectory there looks quite bad, with the economy generally looking like it's recovering around the world. As you say, inflation more likely to pick up than it was, and governments possibly becoming more willing to spend than they were before.
And gilts, we still don't love gilts, do we?
Nope, really nothing much in the way of gilts in the portfolios at the moment. Where we have added more is in emerging market government bonds, which is really a play on emerging market currencies. And these are still very beaten down, actually, from the dollar strength over the last few years. So we think there's some interest there, particularly as the dollar now seems to be weakening quite significantly.
Okay, so we've been underweight equities and underweight fixed interest. So we must be overweight something, and it's been alternatives. And I know you've been working very, very hard on alternatives. And there's a slide on the screen right now which will show people how it is that the alternative portion of the portfolio has performed over the first couple of months of 2017. What's your thoughts going forward on alternatives, Chris?
I think they've filled the gap left by fixed income for us up to now. But going forward, they will have another role to play, which is they'll fill the gap left by equities. As equity valuations keep on trending upwards, there's going to be a point where we just won't want to own them so much.
Okay, so, and we still got about 12% cash targeted in a balanced portfolio, so you've still got some ammunition, so should markets move and you see an opportunity, you've got the ability to do so.
Yes, that's right.
Okay, so overall, if I could phrase it this way, our approach to managing the portfolios going into Q2 of 2017 is pretty cautious. We remain underweight in equities, we remain underweight in fixed. We've got some alternative positions which are pretty low risk, non-leveraged type positions, and you've got a bit of cash to spend. Having said that, we're still on track for hitting the expected returns. So the style of management that you'd expect from 7IM is what you're seeing with the amount of political uncertainty that we've got right now. Chris, anything that you want to add to finish?
I would just echo that sentiment that, we've had a good run up in markets and our portfolios are closing in on the expected returns at quite a fast pace. So we don't feel any compulsion to chase the markets at the moment. And let's sit back and see where this political risk really plays out before we go back in.
Oh, fair enough, and indeed that's what our customers pay us to do. Chris, thank you very much, and we look forward to seeing everybody in another 3 months.